Hello, I'm Shirley. Today I want to share a topic regarding whether you should buy a car under individual name or under enterprise name. So a lot of freelancer or the sole proprietor like to ask me this question. Actually, if let's say I buy a car, right, should I put under individual name or should I put under the enterprise name? In Malaysia, purchasing a car for daily transportation is very costly because you need to pay the traveling expenses like the petrol, parking, toll, and also the maintenance. But do you know that if let's say you purchase a car under a commercial name, actually it's more costly on the road. So in this video, we are going to explore the smarter way to claim the transportation expenses.
In Malaysia, purchasing a car and covering daily transportation expenses can be costly. For SME owners, freelancers, or corporate executives, such expenses often become non-deductible tax burdens if not managed wisely. However, by structuring ownership under a company and leveraging the appropriate tax provisions, these costs can be legitimately claimed as business expenses, thus achieving substantial tax savings. This article explores the differences between company-owned and privately owned vehicles in terms of tax treatment and provides practical suggestions for expense claims and planning strategies. Company car versus private car, key tax differences. If the vehicle is registered under the company's name, it becomes a corporate asset and is eligible for capital allowance under the Malaysian Income Tax Act. Car loan interest is tax deductible, but only for the proportion of use related to business purposes, for example, 70%. Insurance, road tax, and maintenance costs can be claimed as business expenses, subject to the same business use proportion. In contrast, if the vehicle is registered under an individual's name, it is considered personal property. Capital allowance cannot be claimed. Car loan interest is not deductible. Insurance, road tax, and repairs are usually treated as personal expenses and not deductible. Upon sale, the disposal of the personal vehicle does not trigger taxable capital gains. Recommendation: if the car is primarily used for business, for example, sales, consulting, logistics, purchasing under the company's name allows access to tax relief and capital allowance benefits. However, if the car is mostly used for personal commuting, company ownership may raise tax compliance issues. Restrictions on loan interest and depreciation deductions. According to Section 33 of the Malaysian Income Tax Act, only the portion of loan interest that relates to business use is deductible. Capital allowance is claimable based on the cost of the vehicle and must be claimed in stages based on the asset's expected lifespan, typically 20% per year, or under accelerated capital allowance schemes if applicable. Example: a company purchases a vehicle worth Rm 100,000 for sales purposes. If 80% of the usage is for business and 20% is personal, only Rm 80,000 can be treated as business-related capital expenditure. Depreciation and interest deduction must then be calculated on that amount. Petrol, maintenance, and toll fees. Expense, claim guidelines. Petrol, claimable if the vehicle is company-owned and receipts are provided, along with usage justification. Tolls and parking, fully claimable when tied to business purposes. Maintenance and repairs, must relate to the company car. Supporting documents, for example, invoices, are required. Insurance premiums, fully claimable, but luxury vehicles, for example, high-end sports cars, may require justification for business relevance. Important: the tax authority has the right to audit and challenge any claims, especially if the business versus personal use ratio is not clearly defined or documented. 2 ways to use private cars for business purposes. 1. Mileage claim method is suitable for employees and freelancers. The common rate is 60 cents per kilometer. It must record trips in a logbook, indicating business purpose and distance. 2. Vehicle lease agreement. The individual leases their personal car to the company. For example, monthly rental 1,000 ringgit is paid by the company. The company claims it as a business expense, while the individual must report the rental income as taxable under personal income. Risk analysis and compliance advice. If a company car is heavily used for personal purposes, the tax authority may reclassify the associated expenses as non-deductible. Abusive petrol claims or failure to maintain detailed records may result in back taxes and penalties. Claiming excessive costs for luxury vehicles, for example, Lamborghini, Porsche, is likely to raise red flags and increase audit risk, especially if business relevance is unclear. Conclusion. While vehicles are a daily necessity, they can also serve as strategic tax tools for business owners and professionals. With proper planning, whether through company ownership, proportionate expense reporting, or structured leasing, transportation costs can be optimized to reduce cash flow burdens and enhance tax efficiency. Nevertheless, compliance is key. All claims must be legally justified and backed by complete documentation in case of tax audits.
So this is the video that I want to share today. I hope you like it. Thank you for watching.